It was a pretty calm close to a holiday-shortened week, with the S&P 500 higher by 0.36% at the close. We were led higher mostly by some of those AI-themed stocks, particularly Google/Alphabet and Microsoft were really leading the way here in the markets today. We did see only 53% of the stocks closing in the green, so that told us we had more of an impact from some of those mega cap growth-oriented areas. We did see a nice bounce higher in the utilities and REITs today as interest rates were really in a house of pain here over the last couple of weeks. In fact, we have closed today with an oversold cluster signal on the 10-year Treasury yield. We also have the VIX making quite the move lower. We're basically at 6-month lows on the VIX, and we've now gone 11 days without even a 1% pullback in the S&P 500, and that hasn't happened since last year. So we're probably due for a little bit of a pullback here at some point as we head into next week. Nonetheless, the bulls did rule the day once again. In tonight's trade application example, I want to focus on one of the technology companies that I admire the most as a dividend growth investor, but we're going to play it from an iron condor perspective. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's April 6th, 2023. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, then go down below into the description area. Make sure you're signed up for our email distribution list so that way you can be notified whenever we post these videos. Remember, tomorrow's a holiday, so you won't hear from David or myself tomorrow. On Monday, I think David said he will be back early enough to do the Market Outlook video for you on Monday night, but next Tuesday I will be gone. So he's away this week and I'm away for 2 days next week, but that should only affect one of these presentations next week. So anyway, with the different vacation days that we're taking here lately, it's especially important for you guys to be on our email distribution list. In addition to that, we're heavy users of Twitter, and if you're not doing so already, I would encourage you to follow me. My handle is at Brandon Van Zee, and we really appreciate those of you that click like and retweet on these Market Outlook related posts. And then last but not least, we do have a presence on Facebook. Feel free to join our group at that web address you see in the logo in front of you. All right, let's go ahead and jump into today's trade activity. And as you can see, I've got the S&P 500 heat map pulled up here in front of us. And it was a bit of a coin flip as to whether stocks closed in the green or in the red here today. I will say that we started off on a bit of a sour note as we kind of went into one of my classes. Some of you know that I teach my Q&A class bright and early on Thursday mornings. It starts an hour earlier than our typical classes, and so it started a half an hour after the market opened, and at that time we were down over 0.5%, somewhere in that general vicinity. That class ended up lasting about 5 hours today, so for those of you looking for additional content over the long holiday weekend and you're a premium member, feel free to check that out. I did just get that recording posted. Remember, the longer the classes are, the longer the upload process is as well. So that is available now for any of you that want to check that out if you're a premium member of Market Scholars. But the point is, when I went into class, we were down, and it looked like it was going to be a little bit of an ugly day. By the time I got out of that class 5 hours later, and by the way, I normally don't go 5 hours, it's usually 3.5, but since David was away today, I didn't need to get the WebEx platform over to him, so we had a little bit of flexibility there. And by the time I got out of that class, the market was up nicely, so we had a nice little reversal during the middle of the day there, and we were able to hold on to some gains when it was all said and done. I believe the market was up about 0.4%. As we look at this, it does seem like we have plenty of red in there, considering the overall end result of the market. And of course, when that is the feeling, or that is what we sense when we're looking at this graph, usually the answer to that puzzle is that we had the mega cap tech stocks leading the way on a day like that. And that was the case here today. In fact, it was a very good day for those types of companies. Looks like Alphabet was up about 4% here today. That chart, by the way, if you look at it on like a 10-year weekly candle chart, I really like the way that it's shaping up. It's carving out a pretty long base. It's taken some time to kind of try to establish a bottom, and it's kind of felt a little bit like it's like taken longer than you would prefer if you were a trader, admittedly. But we did go through this whole period of time here with AI really hyper focused on Microsoft, and you can see Microsoft had a brilliant day today as well. It was up 2.5%. So Microsoft has that big investment in ChatGPT. Today, Google came out with some new information about how they're planning on building AI directly into Google search here in the future. And so that kind of really impressed those operating on Wall Street today to the point where you had a nice healthy 4% increase. So I'll be looking forward to seeing those AI wars playing out in future years between Alphabet and Microsoft. You can also see that NVIDIA was up about 0.5% today, and Apple was up about 0.5% today. So they weren't necessarily as big and aggressive moves as Microsoft and Google. Nonetheless, they didn't hurt the market today, and that's really all we needed in today's case. So those are some of your bigger players out there from a technology perspective. You can then throw in Amazon into that conversation, and you can see Amazon was up about 1% here today, and so that helped as well. What did not help was Tesla. It was down just a smidge here today. Berkshire Hathaway was up quite nicely, up about 0.7%. So you can see that the biggest squares on the board were largely green. And I could also mention Meta was up 2% today as well. Of course, the old Facebook there. So your bigger players mostly seem to close in the green today, with just a couple of exceptions here or there. So that's the reason why this looks like a mixed result in terms of breadth here, but we actually had a pretty decent end result on the S&P 500 due to its market cap weighting. In terms of those areas that were out of favor here today, energy certainly caught my eye. We had a good chat about Phillips 66 yet again in class today, so feel free to check that out as just one example. And of course, they weren't alone. It looks like pretty much all of the energy stocks were down here today, even the big boys like ExxonMobil was down 1.6% and Chevron was down 1.3%. But some of those refiners like Marathon Petroleum really struggling there today with a 3% drop. On the flip side of that, you can see the utilities were exact opposite. Pretty much all of those were up. Looks like there was just one exception there. This one right here was Pinnacle West. It was down just a touch here today, about 0.5%. Otherwise, a very strong day out of the utilities, and also a very strong day out of the real estate investment trusts. So those interest rate sensitive groups seem to perk up a bit here today on the green side. Looks like our industrials are still a bit of a mixed bag. It was good to see the transports finally starting to perk up a little bit. Some of those railroad companies there like Union Pacific up over 2%. But you will notice that some of those areas that were out of favor earlier this week, like Caterpillar and Deere, they still couldn't stabilize. Caterpillar down another 2%, Deere down another 1% in this case. So a little bit more hit and miss there. Down below in the consumer staples, does look like we had more green than red. And so that kind of followed suit with what we saw to the other defensive areas like the utilities for the most part. By the way, Costco had a pretty rough session. It was down about 2%. That one was in the news here a bit more today. So all in all, it was a reasonable day. I would say that it was definitely one that was pushed around by the mega cap tech, whereas it wasn't such a great day for most of the market, but they covered up a lot of the mistakes there in the mega cap world. Let's go ahead and take a look at the specific breadth numbers now. And you can see that as I've pulled up the S&P 500 here, 264 stocks closed higher in the S&P 500 today. So that's good for about a 53% hit rate. So in other words, pretty darn close to a coin flip, right? 53% to 43%. 53% to 47%. So in other words, it basically could have landed on heads or tails for all we know. Yet, when we look at the charts, again, we had a pretty reasonable day. We closed higher by 0.36% on the S&P 500, thanks to Alphabet and Microsoft mostly in that regard. So a decent day there in the end for the S&P 500. The Dow was effectively flat here today. Technically, it closed up by 0.01%, the slimmest of margins. And then down below here, you'll see the NASDAQ was today's leader. Again, technology in focus and has been for quite some time at this point. It was up 0.76%. And then the Russell 2000 was up, but just a skosh. It was up by 0.13%. You'll notice that the Russell 2000 remains with a bearish posture at this point and is still below its falling moving average, whereas the other three charts that concentrate more on large cap companies, they are still in the mode of strongly bullish intermediate posture, along with rising moving averages, 30-day moving averages specifically, that they all three are above. And of those three, to my eye, it suggests that the NASDAQ is our leader at the moment, with the S&P 500 coming in second, and then we've got the Dow Jones probably third, and then way back behind, the front runners are the Russell 2000, doing its best to try to just keep up, but not doing a very good job of that at the moment. Remember when I was with you a couple of days ago, we talked about the idea of those bullish intermediate confirmation signals, and so today we had a little bit of a snapback in the market to help that little bounce back occur. One thing that did catch my eye, by the way, is you'll notice this has been a pretty smooth pathway for the S&P 500 here recently, where we really haven't had much in the way of aggressive selling. So one of the things that I did was I came over here to chart 6D, pull up the daily percentage moves. And I was just curious for myself, because many of you know kind of my process by now. If the market is down over 1%, I oftentimes will try to find a sold put trading idea for you, because that's one of my favorite strategies. And I was just thinking to myself, boy, it's been a while since I've been able to bring one of those to the Market Outlook's attention. In fact, we were talking about one of them earlier in class today when we were talking about Johnson & Johnson and how spectacular of a move Johnson & Johnson made here yesterday, of course, benefiting all of us that sold puts on it over here. And remember, not only did I sell puts on Johnson & Johnson for this Market Outlook video over here, but we also did so in my Monday afternoon options for long-term investors class. So we kind of have a double bonus in that regard off of that really nice news that we heard about Johnson & Johnson kind of settling one of the lawsuits, or at least that's the impression of the market community right now. But anyway, I like looking for those ideas for you guys. They are part of my favorite trades to do. And I was just thinking to myself, it's been a while. I want to put some more on, and last year maybe I got, a little lucky in that regard, because it was such a difficult year last year. We had tons of, 1% sell-off days. And of course, part of the story as well is I only do this video on Tuesdays and Thursdays, so the 1% sell-off day has to occur on one of those days. And sometimes just by the luck of things, it either works that way or it doesn't. But point being, I went back and I was just curious for myself. And this is now the 11th day in a row that we have not had a 1% pullback, right? This blue line down below the black line will be the 1% lower area, right? And you can always glance up here at the labels if you forget about that. But you can see that the last time we had a 1% pullback on the S&P 500 was on March 22nd. We've now gone 11 trading days since having a 1% pullback. And remember, 1% is not asking a lot. 2% and 3% moves, those are less common, but 1% are pretty normal. Yet it's been 11 days now since we have seen that. And I was kind of curious for myself as I went back and was scratching my head. When was the last time that happened? Because it's been a while. And we would actually have to go back here to last year. This is the first time that's happened in calendar year 2023. But back here in November, you'll notice during this time period, we had this 1% move on November 9th. And then 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13. Actually, it was the 12th day right there was the day that you went down 1%. So there would have been 11 trading days between this day right here and this day right here. And again, that's where we're at right now. We've now gone 11 days without a 1% pullback. And then when I was going back even further than that, I looked at this one right here a little bit further back into October, not November, and it was 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 days they got there. So 12 days between 1% pullbacks here, 11 days between 1% pullbacks in November, and then that takes us to where we're at right now with 11 days without a 1% pullback. Now, obviously, there's no guarantee there will be one, but the point of the conversation is we're probably overdue for a little bit more selling, and we're not going to get that tomorrow because, of course, it is Good Friday. But could we get it sometime early next week? Yeah, it's possible. History suggests that we're due for a little bit of a sell-off here or there, and whether that develops into anything serious or not, is anybody's guess. But a lot of times the market makers just like to keep you honest, and they don't want a market just running away up in a way without anybody else involved with the selling side of the equation. So anyway, let's keep our eye on that early next week. Perhaps we do get one of those 1% sell-off days. I am chomping at the bit to get some more of those sold put trades out there for you guys. So I kind of hope it happens at some point, maybe next Thursday when I'm back with you at that time. Remember, again, I'm not going to be here on Tuesday, but maybe next Thursday we'll get a 1% sell-off day and we can look at something else like a Johnson & Johnson again. You will notice, by the way, while we're over here, this purple line down below will show you the pathway of the VIX. And I know that's a little bit harder to see, so let me kind of expand this a little bit more. But the VIX is at 18 right now, and that is basically the lowest level for the VIX in 6 months. I'm going to come over here again to the main charts, and I want to pull up the VIX in a normal candlestick mode and just confirm that. So on the line graph that I showed you a moment ago in purple, we were basically at the lowest levels, but what it is doing is it's only plotting things at the close. Remember, the candlesticks give you the opportunity to not just see what's going on at the close of any given day, but also what happened on the intraday basis. And I'm glad that I pulled this up because I wasn't sure, but now I can confirm with my own eyes that over here on February 2nd, on an intraday basis, the VIX did fall down to 1706, but by the end of that session, it closed up here, closer to 19. So on a closing basis, this is actually one of the lower closes that we've seen here in the last 6 months for the VIX. We ended the day at 18.4. And remember, anything below 20 is considered really low volatility. So that's probably another reason, alongside what I mentioned there with the 11 days in a row without a 1% pullback, it kind of feels like the market is being lulled to sleep right now, and we need a little bit of a jolt where there's a 1% sell-off day at a minimum, and the VIX spiking a bit higher, hopefully breaching 20, which really should not be a difficult thing to accomplish, but in this environment, who knows? So anyway, VIX did have a pullback today with the rise in the markets, no surprise, but what is surprising is basically the VIX is at 6-month lows right now. When we're looking at the rest of the charts, I think I rattled off those results earlier. So really, the takeaway here tonight is we're in coast mode for most of the mega cap and large cap indices, but the fly in the ointment right now remains the Russell 2000, which of course has a large smattering of regional banks within it, which is preventing it from going up at the same degree as these others. But otherwise, it was a fairly solid day, all things considered. Let's go ahead and take a look here at the 3 green arrows strategy now. This will be chart 4D for those of you that are following along at home. And we have basically the same result as what we had on Tuesday. In other words, we've got 3 out of the 4 charts with a 3 green arrow signal. And again, those 3 arrows are the 30-day moving average, the MACD histogram, and the stochastic. And for the S&P 500, the Dow Jones Industrial Average, and the NASDAQ Composite, we do have 3 green arrow signals. The only one that's a holdout at this point is the Russell 2000. You can see that not only do we have a red arrow on the moving average, but we also have a red arrow on the stochastic down below. So with the Russell 2000, we have 2 red arrows and 1 green arrow on the MACD. So we've got work to do there. And I don't know for sure, but my hunch, given that we've gone so long without a major sell-off in the main indices, is that it's probably going to be a little bit hard for the Russell 2000 to giddy up and go this late into a recovery process for the other indices. You'd probably make the bet that the other indices need to have a little bit of a pullback, stabilize again, and make another move higher. And if that happens, what are the odds that the Russell 2000 can go up while the other indices go down a little bit, right? So until the banking crisis is solved, it just kind of seems like the Russell 2000 is in the penalty box at the moment. Let's take a look here now at our 1040 crossover method. And remember when I was with you on Tuesday, I said, well, we'll confirm everything on Thursday because this is the rare week where there is no Friday trading. So technically this is the final day of the week and the markets are now closed. And so I can now confirm that we do have golden crosses officially on 3 out of these 4 charts. And it's been a long time coming for some of them, especially the NASDAQ. If I right click on the NASDAQ here, you'll notice that the last time we had a golden cross was back here on February 7th or prior to that. So in other words, we were in golden cross territory until we got the death cross that particular week. And since February 7th of 2022, I should add, if I didn't say that before, so in other words, not this February, over a year ago was when you got that death cross on the NASDAQ composite. Today, or this week, is the first time in over a year that the NASDAQ now has a golden cross. And remember when I was with you last week or the week before, I was saying that there is a very good chance of that very thing occurring. All else being equal, I'm going to make the assumption that the momentum will continue in coast mode long enough to pull that 10-week moving average in the orange line up and above the 40-week moving average in the blue line there. So it is official now. You can see the background color has changed. How long it stays, anybody's guess. But at this point, I'm not going to be a hater. I'm not going to deny it. Right now, there's momentum on the side of the NASDAQ. And you can debate, back and forth all day long whether it deserves to go up, right, and all this kind of stuff. But the truth is, price is telling us that it is going up. So let's at least recognize it and respect the fact that it's happening, even if some of us may disagree with why it's happening. But right now, we happen to catch a moment in time, particularly artificial intelligence, that is exciting the marketplace, and that is benefiting something like the NASDAQ. And right now, we've had some pretty strong momentum push higher in the NASDAQ. So I would venture to guess that we will stay in this bullish cross territory for at least the next few weeks, minimum. I mean, you could very well go on a run for a year plus, like we had back here. That was an amazing run for the NASDAQ. I kind of doubt it personally because I think that the valuations are already pretty stretched, but I also recognize, in the short term, markets are a voting machine. In a long term, they are a weighing machine. And so in the short term right now, the votes are in and the votes are there for the NASDAQ. In terms of the others, you can see the same type of thing developing for the S&P 500 and the Dow Jones Industrial Average. But what makes those a little different than the NASDAQ is they've already had some flings with bullish crosses here in the past year. So for instance, the S&P 500 did it here for a few weeks here, maybe a couple of months ago. And then the Dow had already been in bullish cross territory last year. Right? The Dow was a leader in kind of that November and December time period. So it lost it for maybe 2 weeks here, and now it gained it back. It recovered enough here recently. Whereas I still have some doubts about the prospects for the Russell 2000. Naturally, if these other 3 go on to some bullish move that is fairly extraordinary, then I have no doubt that the Russell 2000 will be drug up with it, kicking and screaming if it has to. But if we have more of a coasting sideways type of a market from this point, then I do have my doubts that the Russell 2000 is going to be able to get up and over. There's just too much baggage there with a lot of the banks that are involved with it. So if they can prove me otherwise, I'd be happy to see it, because as a long-term investor, of course, I love it when stock prices go up. So don't kill the messenger. I'm just telling you what I see. And right now, it does seem like there's too much heaviness there still in the Russell 2000. So I'll keep you posted if things change in that regard. Otherwise, this is a promising development here that we see at the end of the week with 3 out of these 4 charts back to golden crosses on the 1040 weekly crossover method. All right, let's go ahead and pop on over here to the internet briefly. I always like to get a chance to say thank you to those of you that help support this free presentation that you're watching right now. And as I always say, as long as you're willing to step up to the plate and click like for me there on Twitter, and as long as 100 of you are positively benefited by the 3 hours of our day that is taken out to do these videos, then we're happy to do them as often as possible in the future, assuming that we're in town. Obviously, with the vacations recently, that's a different story there. But generally speaking, I do track whether people appreciate these videos or not. And if they are appreciated, then I'm more than happy to put my effort into them. If the videos are not appreciated, then I'm probably a little bit less inclined to do that. Not to say I won't, but just to say I will probably spend less energy upon doing that and perhaps doing them less often. So as I always say, as long as we're up and over 100 likes, I'm more than happy to do a full-length video for you, including a trade application example and the 12 grid analysis and the factor selector analysis and sector selector and all that kind of stuff. On the other hand, if these are getting a little bit long in the tooth for some of you, that's okay as well. I certainly understand. No sweat off my back, because it just means less work for me, because if less than 100 of you click like, then I'm not going to spend as much time on these, and we'll just make sure it's only a quick and easy 15-minute version. So thank you to the 119 of you that stepped up to the plate for me since Tuesday. I appreciate each and every one of you there. Let's do some shout outs. How about thank you to Bob Curran, thank you to Irvin Beard, thanks to Das, thanks to Terry Lawson, thanks to Stephen Young, thanks to Robbie Axelrod, like that name, by the way, from the TV show. Thank you to Dennis Mo, thanks to Nafi, thanks to BZ, thanks to Ash, and to Gene, and to Fathy, and to Duncan, and Tubbs, and Ron, and Nietzsche, and Brian, Building Management, and Brian, and Arth, and Tom, and Sandeep, and there he is, the OG dividend growth investor, Ian. I love his work as well. He's a very optimistic guy, which I appreciate. So thank you, Ian, for your assistance here as well. There's Scott, and there's Keola, Stock Market Junkie. We've got Jeff and Michael and Randy and George and Jayesh and James and Dennis and Serene and Ann and Business News and Susan and Lawrence, and the list goes on and on and on and on. I can't get to all of you, but I do appreciate each and every one of you. Thank you very much. Let's go ahead and take a look here at the factor selector. A reminder that I taught my question and answer session earlier today. The longest class I've ever taught, by the way. We shut it down at 4 hours and 55 minutes, just shy of 5 hours. And I did not even get out of my seat during that entire time. So my voice was pretty raw. I was ready for my second cup of coffee, but it was an enjoyable experience because we get a chance to dive deep into my philosophies on dividend growth investing and value investing and selling puts and all that kind of stuff. And a lot of times we can only scratch the surface of that in our normal trading room. So it's nice to have that more flexible time period on our Thursday mornings to kind of dig into the details a bit more. So feel free to check that out over the weekend if you're a premium member and looking for additional content. We talked a lot about things like the banking crisis, I think was kind of the core theme of today's conversation, and some of the stocks that, we're looking at that perhaps are babies being thrown out with bathwater, right? And some of the risk that continue to be in place right now and what we need to look out for as well, because obviously it's always easier said than done in hindsight which stocks to pick when, a certain industry falls out of favor. So anyway, enjoyed that conversation today. David did not teach his ETF class today because he's out of town, but he'll be back in action for you next week. All right, let's take a look here at our factor selector tool. A reminder that this gets updated on Tuesday nights, and so it's a couple of days stale here by the time I show it to you in this free video on Thursday, but those of you that are premium members obviously have access to it in real time. So let's go through it, see what we can learn. Really not a whole lot to share with you here this week because the rankings pretty much held firm across the board. Quality is number one for the 5th straight week. And remember, the reason behind that, from my impression, is that technology is doing very well. And believe it or not, if you look under the hood of the quality ETFs, it is a huge smattering towards technology, especially stocks like Microsoft and Apple. And of course, they're holding up very well in this market environment. Johnson & Johnson is also a poster child of quality, alongside those other two with AAA credit ratings. And Johnson & Johnson was a bit of a laggard here a few weeks ago when we were selling puts on it, of course, in this market outlook video. But with the news that came out here earlier this week, settling some of those lawsuits and the stock going up like 4% yesterday or what have you, now even Johnson & Johnson is helping the quality factor ETFs in addition to what was already a strong Apple and Microsoft. Low volatility came in at number 2, so that is being benefited by interest rate sensitivity. As I mentioned to you guys when I was with you on Tuesday, we nearly had an oversold cluster signal on the 10-year Treasury yield, and who knows, maybe we got it today. I haven't even looked at it, so we'll find out here in just a moment. But the point is, interest rates have been under pressure, and that has benefited those interest rate sensitive areas. Going back to what I had mentioned earlier on the heat map, we saw today the utilities only had one component that was in the red in the S&P 500, and the REITs were nearly as good, not quite, but nearly as good, with very strong performance today. So remember, the utilities and the REITs are going to be big components within the low volatility factors. Momentum is starting to perk up, thankfully, because it's been a while. I teach one momentum class here at Market Scholars as well on Monday mornings, and it's been a tough sledding for that particular strategy over the past year or so, but it does finally kind of feel like we're making some progress. I hope I'm not jinxing it by saying that, but there has been a nice benefit, a nice push with the wind in the sails of technology leading the way. There's a lot of really good looking technology charts out there. It's not just Apple and Microsoft. If you go through all of the tech stocks in the S&P 500, you're going to like what you see. There are some really nice stuff. I kind of felt like that Men's Warehouse guy there. You're going to like the way you look. You're going to like what you see in the in the technology stocks when you look at them on chart 1A here at Market Scholars. Low size fell week over week. And again, from my perspective, that's because of what we are seeing with the banking crisis and with the regional banks really just kind of still scraping the lows. We talked about some of the quote-unquote horrible price action, wink, wink, if you're listening, Vernon, you know who I'm speaking about, or perhaps train wreck, hello, Emil, right? So we have some colorful language about how we describe charts on occasion here at Market Scholars, and so have a little bit of fun with that. But it is true, the banks have been absolutely blitzed here lately, and that has hurt that low size category there. Value stocks are second to last at the moment. And keep in mind, that is largely being affected by the same thing. Value in this world today is made up of a lot of financials and a lot of oil stocks. Now, oil stocks have perked up here more recently, so they're not necessarily the problem there, but the financial stocks have not. And the longer that the financial stocks languish, the greater the chances that value is going to have a hard time getting you up and going. And that also is being affected by the risk-on, risk-off mindset, where technology is so much in favor right now. Remember what we were talking about on Tuesday with technology leading on the sector selector, communication second, and then discretionary third. None of those areas you think of as core areas of value. Those are areas of growth. And that same mindset is what is affecting dividend yield at this moment as well. Dividend yield is a little bit more diversified than value. Nonetheless, it's not benefiting in this marketplace at the moment because so many people are chasing into the growth themes at the moment. So they're just kind of sitting out the race. They're not doing terribly in terms of performance. They're just not keeping up with some of the bigger moves on the upside. Remember, right now it's the NASDAQ composite that is leading at an index level. And if you think about where do you find most of your dividend yielding companies, the index that probably should come to your mind at a high level would be the Dow Jones Industrial Average. And if you compare the NASDAQ to the Dow, clearly the NASDAQ is the leader right now. And that kind of leans into what we're seeing out of the quality factor at the moment as well. All right, let's get back on track over here with some more charts. And let's do some 12 grid analysis, starting with chart 5A. This is our asset class 12 grid. And as this pulls up here, a reminder that these charts, background colors will tell us what the current market forecast posture is on them using the intermediate line. And lo and behold, my hunch was correct, although I hadn't seen it yet. Now I can confirm it with my eyes. The chart in the lower right-hand corner here is the 10-year U.S. Treasury yield. And remember when I was with you on Tuesday, I made a point to expand this chart because my hunch was that we were awfully close to a cluster, but we just missed it by the narrowest of margins right here, right? The green line was barely above 20, even though the blue and the red lines were easily below it. So I guess I shouldn't be surprised to see that the next day and then following up again today, we do have those clusters here. So these are the first official clusters on the 10-year Treasury yield since going back over here to January 19th. And you can see that that was a time when it probably would have made sense to either, get out of your short yield positions or perhaps even go into your long yield types of plays that are out there, because at that moment we pretty much were bottoming in that kind of era, right, a few months ago, and we went on a very solid rally after that. Can we pull it off again here right now? We'll see. That is not my expectation, generally, as I've shared with you guys countless times in these videos over the years. My expectation when I see something like this set up is that we get a reversion to the mean type of a move. So in other words, I have no reason to believe that we're not close to some sort of a bottom in interest rates in the short term. But whether it's actually trend changing or not, I'll reserve my opinion on until I can see more evidence of that. But my initial thought with most charts is that when we get these oversold cluster signals, I'm going to expect some sort of a reversion to the mean type of a rally. But once it starts approaching this falling 30-day moving average, more times than not, it rejects it and it pushes back lower once again. So it's kind of like a momentary relief of pressure there, not an actual trend change. This one was a little different, right? This one was more impressive. It was able to get up and over those moving averages a little bit more. And I do wonder if, kind of these macro charts, that's a little bit easier because there are outside influences, right? The Federal Reserve is obviously an influence on interest rate, is not purely driven by what's happening with supply and demand the way that like an individual stock oftentimes is. So, that could play a little bit of a role here as well. But I thought I would point that out because, if it seemed like, interest rates just kept going lower and lower and lower and you're wondering, are we going to get a bounce? Well, I think we're probably due for one. Whether it's a substantial bounce or not, anybody's guess. But keep in mind that one of the things that we are fighting against at the moment is OPEC and this huge rally in oil prices that we've seen over the last week or so. Remember that rising oil prices are inflationary. What is the thing that the Federal Reserve is trying to fight right now? It's inflation. So if the Federal Reserve was hoping to start cutting interest rates, yet you see oil prices flying higher, they're going to have a hard time justifying that because they're probably not going to want to let this fester, right? They want to kill inflation. They want it dead. They want it done. They want it over. And so they're probably going to overdo it would be the way that I would think about that in terms of their hawkishness in the market, even though the market at large seems to think opposite than me right now. So I could easily be wrong about this. But my basic level of thinking there is we still have work to do when it comes to inflation. If anybody's been in a grocery store lately, you know how much you are paying for things way beyond what you were paying just a year and a half ago. And so I don't think we're done with the fight against inflation yet. Oil prices are one other friendly reminder of why that could be the case. And if that is the case, then there could very well be upward pressure in interest rates in the short term, especially in the face of oversold conditions that we see right now. So we'll keep our eye on that. Anything's possible, of course, and I'll be here to report whatever happens, whether it's what I think or not, and we'll all find out there together. On the other corner, and the other bottom corner here, we also have a dark pink chart, so similar to the 10-year Treasury yield with a strongly bearish posture. The US dollar has a strongly bearish posture. And both of those things are benefiting the market, right? The market likes it when the US dollar is weak. The market likes it when interest rates roll over. All else being equal, profits are easier to come by for multinational corporations that are headquartered in the United States when those two things are true. So last year it was oftentimes the opposite. We were in an environment where the US dollar just kept ripping higher and treasury yields seemed to know no end of climbing. And in that type of an environment, the stock market got walloped. This year it's been the opposite. Those two have allowed a release of pressure, and that pressure has largely found itself to the upside, even in some of the more speculative assets like the NASDAQ stocks, and even in Bitcoin, right? Bitcoin is holding its own. It doesn't seem like it's advancing at quite the aggressive pace that it was earlier this year, but the sheer fact that it hasn't fallen out of bed is rather impressive. It's kind of been stuck up here at about 28,000 here for really the last 2 to 3 weeks. And as that has happened, and it's kind of just blowing off steam by going sideways, remember the moving average is coming up to it. So the last time that occurred, you'll notice we had this big rally in Bitcoin right out of the gate this calendar year. And then you spent about 2 months going sideways. You had this really weird movement where it cracked below that moving average, probably, there to frustrate a few people. But largely that was sideways activity. And during that time, notice that as it was going sideways, the moving average was going up to it. And that happens quite often. And oftentimes you will find that that is a bullish excuse at that point to rally it higher, which it did. Now we're in this sideways consolidation pattern, so who knows, maybe we'll be stuck in it for a while. But if that moving average keeps on going higher, there could be the same type of an excuse to push Bitcoin to the next level once again. It's kind of like, the theory of apartment buildings where you blast through the roof of an apartment building, you go onto the second level, you spend some time there, you blast through the next level, and so on and so forth. So that's kind of the stair-stepping effect that you're seeing out of Bitcoin at the moment. So all in all, no complaints there. Usually Bitcoin is used to kind of judge risk appetite, and right now there's a reasonable amount of risk appetite out there. In terms of our commodities, you will see that gold was down today. Now keep in mind, I didn't mention this specifically. The US dollar was actually up today, just barely, by 0.07%. We did have an oversold cluster signal here, so no surprise that after that cluster signal, we've now had 2 up days in a row, but this is not a very ambitious rally, right? That is a whimper at best so far. It doesn't mean that it can't, establish into something more significant, but right now, that's not a very aggressive snapback or reversion to the mean quite yet. So I'm not going to make too much out of it, but you will notice that the last 2 days with the US dollar up, that gold prices have come down. And remember, on Tuesday, we had the oversold cluster on the US dollar. We had the overbought cluster on gold. So should we be surprised that 2 days later, they've kind of reverted to the opposite direction? No, I don't think so. But the trends are still in place. Gold is still in an uptrend. The US dollar is still in a downtrend despite the last 2 days. In terms of our bonds, have a little bit of a difference here today, and that is with the high yield bonds. Remember, on Tuesday they had a bullish posture. Today, that weekly bearish. The other 2 categories, long-term U.S. Treasuries and foreign bonds, remain with their strongly bullish postures, and they're in reasonably good shape at the moment, above their rising 30-day moving averages. But again, if you assume that this oversold cluster on TNX is going to lead to a snapback in rates, then that will likely mean that our bonds are due for a little bit of a pullback here as well. It doesn't have to ruin the uptrend that's been established or the attempted bullish reversal that's been established, but it needs to cool off a little bit is kind of the way that I would think about that. Up at the top here, you will notice that foreign stocks actually outperformed the U.S. market today despite a small rise in the U.S. dollar. And that's another fairly optimistic way to look at risk appetite, all else being equal. We'd like to see the foreign markets outperforming the U.S. markets because the U.S. markets are oftentimes viewed as pretty stodgy. Things have changed there to a degree because, of course, some of the most successful tech stocks on the planet are headquartered here. No disrespect to those of you in the Netherlands with ASML, and also those of you over in Taiwan with Taiwan Semiconductor. Of course, Germany has SAP. There's still good tech stocks outside of the United States, but without a doubt, when you think of the typical tech stock, you do think of the U.S. And so, in general, there's been a little bit more of a speculative push in the U.S. than normal because the technology sector has become the most important here over the last 10 years or so. But today we had a pretty strong showing there out of the foreign stocks. EFA was up 0.47%, and then EEM, which tracks the emerging markets, was up 0.41%, both just barely beating the S&P 500's performance today. Both of those remain above rising moving averages and have strongly bullish postures. Let's take a look at our sectors now. Chart 5C in this case. And it's still a pretty good picture. I remember when I was with you on Tuesday, it was a clean sweep for the bulls on that day, but we've seen continued selling in the industrials since then, and now that's been enough pressure to the downside where we have reverted back to a strongly bearish posture on the industrials here all of a sudden. And remember, the industrials were actually, for a quite large swath of time in the last, let's call it half a year or so, the industrials were a leading area. There were some peculiar elements to that. Remember, the industrials is where you're finding your Lockheed Martins of the world, right? Those defense contractors that benefited during the Russia-Ukraine thing. So, it wasn't necessarily that the world's economy was booming, but they were holding their own. And all of a sudden, that's being called into question. Remember when I was with you on Tuesday, one of the big stories I was sharing with you was what was going on with anything construction related. That was the reason for my trade on VMC, and I didn't even look at it today, but I did see that yesterday it was down quite a bit more. So I'm happy with the way that trade has developed so far with the bearishness there. But with the industrials, the area specifically that was getting blasted on Tuesday was Caterpillar and Deere and Eaton and some of those Parker Hannifin and other construction-related areas. And that has not corrected itself. In other words, it hasn't gotten any better. It's continued in the following days since then. We now have 3 days in a row to the downside for XLI, and I think if I'm looking at the other charts, that is the only sector that can make that claim. It's the only sector. I take that back, sorry. Materials right next to it. Both of those two are the only two that have 3 days in a row currently to the downside. So that's kind of where we're seeing some pressures here right now. And remember, materials is where you find those aggregates producers like Vulcan and some of those as well. But I think that's kind of playing into the same theme. Construction is really pulling back all of a sudden, whereas the rest of the market is hanging in there just fine. All of the other sectors do continue to retain their strongly bullish postures. The ones that continue to be the most impressive to my eye are technology, communications, and then I talked about consumer staples with you on Tuesday, saying that this has been a runaway freight trade. Not a lot of people are talking about it, but my, oh my, are those consumer staples rocking it to the upside. Some of you saw me tweeting about Hershey's here a day or two ago, saying how it just looks like Teflon over the last 10 years. I mean, that stock doesn't know how to pull back. Pepsi is also a very strong performer in that group. Monster Energy is rocking it here once again. So there's a number of those consumer staples that look mighty strong here all of a sudden. And just a month or so ago, they were looking like they were struggling a bit. So keep your eye on that area. And to kind of tie on to that conversation, I would also include healthcare and utilities all of a sudden. Healthcare, some of you saw me tweeting about that. We talked about it here in class today as well, where I was showing the foregrid on the dividend stair-step charts of Johnson & Johnson, of Pfizer, of Bristol Myers, and of Gilead Sciences. I could also throw Amgen in there. There's a number of them, but those are names that we oftentimes focus on in my long-term investing classes. And just a few weeks ago, people were just throwing them away, and it was peculiar to me, to the point that I had to say something on Twitter. And I'm glad I did, because here we are just a couple of weeks later, and those things have snapped back beautifully. And anybody who took action on them just a month ago is probably very happy about that at this point. Now, can that stall out? Of course. Things don't go up forever. Things don't go down forever. That's the whole point of believing in reversion to the mean as a long-term investor. But those that were continually selling off healthcare right here are probably regretting it just a couple of weeks later up here. And utilities is a little bit of a different story there. I don't think the businesses within the utilities are as strong as the way that I think of them in healthcare, but utilities are driven by that interest rate sensitivity, and I think that's really benefited them here in the last couple of weeks as interest rates have fallen to their oversold cluster signals. But remember, that could unwind as well. If we do expect some sort of a reversion to the mean out of interest rates a little bit higher, I would assume that this overbought cluster that was plotted on utilities is a little bit of a warning sign that we could give some of this move back. Hopefully there was enough of a push higher here where if we do give it back, maybe we just come back to this breakout area and then we stabilize around there and then there's another leg higher. That's what I'm hoping for. We'll see if that plays out or not. All right, let's go ahead and take a look at our trade application example now. And for that, I will just pull up chart 3A, and I'm going to look at TXN. This is Texas Instruments. This is actually one of my favorite tech stocks as a dividend investor. People don't talk about it nearly as much as they talk about Apple and Microsoft and Nvidia and all these other fun stocks. Texas Instruments seems to me to be just quietly going to work year after year after year for investors. It's really been quite extraordinary. If you want to see what the dividend stair-step chart looks like on Texas Instruments, I'll go over there real quick just to kind of show what I'm referring to. And this has been just a quiet powerhouse in the last decade. You can see it's up nearly 500% when including those dividends. And every time it dips back into this blue zone is an opportunity to load up on it. And I'm glad we've had a few of those opportunities in my dividend classes over the years. I wish we could have more, quite frankly. That's how well this stock has treated us. So I think quite highly of Texas Instruments personally. And when we're looking at it in the near term, it seems to me that it's at a point of stabilization after a fairly intense sell-off that we've seen here more recently. You can see we had a 3-day sell-off that followed a 4-day rally, and that 4-day rally started at the 30-day moving average. The green line was in place at that time, meaning that the moving average itself was already rising, and that would have been a reasonable time to assume that a bounce could develop from that moment. But of course, nothing lasts forever, so after a very spectacular 4-day rally, you gave back nearly all of that with a 3-day loss. Well, here we are again, so if you missed it the first time right here, maybe it's giving you another chance. It's sitting here right on that rising 30-day moving average, and you can see that that was enough to actually pull that blue line up out of the lower reversal zone, so we now have this blue background color established here. But on the flip side of that conversation, you can see this is an underperforming security. The S&P 500 is up here, whereas this stock, Texas Instruments, is down below here. This is ticker symbol TXN for those of you that aren't familiar with it at home. Anyway, what I opted to do, and by the way, you can also see, you don't have to take my word for it that this is a strong company. Look at the labels up at the top. All of them are green. And that's saying something for a stock in the tech sector. Remember, a lot of tech stocks, even some of the most successful ones, take a look at Microsoft as an example. Everybody thinks the world of them once again because of their ChatGPT division. They're still down over the last year, right? And I don't know if Apple is, but it is, yeah. So Apple is also down over the last year. Yet here's old Texas Instruments, and it's actually up over the last year, just by the slimmest of margins, but nonetheless, it's doing something and is resilient enough. Not a lot of people talk about it, but this thing also kind of feels like a Hershey's type of a stock where it is very, very high quality. It doesn't get a lot of buzz. All it does is roll up its sleeves and goes to work for investors. So what I opted to do here today was an iron condor. And remember, I've already done the trade. It was done while the market was open, and I've sent out all the trade details to those of you that are premium members on our Telegram channel. And what I opted to do was the May contracts, the normal monthly contracts, And on the top side, I did the 195-200 bear call spread. And on the bottom side, I did the 165-160 bull put spread. So you combine those two things together. Those two different trades produce two different credits. And that kind of helps you juice your returns a little bit. But it also means that there are two different levels of risk for the trade. These blue lines that you see that I've drawn here on the charts represent my break even in this trade. I got $1.49 for selling that $5 wide iron condor. So our return on risk on this trade is about 42%. Usually I'm shooting for a 30% return on risk. This one is quite a bit more than that, so there's more opportunity here, but it's because I'm also taking more risk here. You guys are probably noticing already that this company, like so many, has an earnings announcement coming up. As I was joking with the chameleon video on Twitter here yesterday, it's about time for CNBC to tell all of us that it's the most important earnings season ever, right? Like they tell us every single quarter. So anyway, it is true. We're in the midst of earnings season here. It's about upon us. Remember, the banks will be first out of the gate here as soon as late next week is when we'll start hearing from them. And most of the large companies in the United States will report earnings within the next month or so. And so Texas Instruments is not alone from that regard. Nonetheless, be aware that that is a risk. And some of you may not like trading through an earnings announcement, and I don't necessarily blame you. But one of the things that is nice about this type of a trade setup, when you're doing an iron condor, you know what your worst case scenario is. It is risk defined as long as you're not messing around with it and trying to move in and out of your iron condor and shut down one side and leave the other one on, that sort of thing. That can open up the door to more risk. But if you're just putting it on with the 4 strikes and you're leaving it on, then you know what your worst case scenario is. And so if there is a massive move on earnings, you will know that you are somewhat protected, and you should have position sized accordingly. So never risk too much, obviously, and this is not some sort of a gambling channel or something like that, right? We're trying to make reasonable decisions with our money. And so anyway, I thought this was a reasonable one, despite having an earnings announcement coming up, but some of you may disagree with that, and that's perfectly fine as well. I obviously know in advance that plenty of my trade ideas will not go the way that I want them to, but I will still try to find effective ones for you guys nonetheless, assuming that you're willing to support the channel with the likes on Twitter and things like that as well. But I kind of like this setup because we had the pullback. Had this stock gone up 3 days in a row after this 4-day rally, I would have been a little bit more concerned that this is a true breakout to the upside. But right now, I'm still in the mindset that while I expect support to hold right here and that we could get a bounce out of Texas Instruments in the short term off of this rising moving average, I'm still not to the mindset that this is one of those like NVIDIA situations where it is just running away from the pack at the moment in time. So this strikes me as more of a sideways pattern that we have, despite how much I admire this company, and therefore could be a better candidate for an iron condor. Remember, for those of you that are newer to iron condors, what you are hoping for is that this stock stays between these two break-even lines. So it's a little bit different than most other directional trades where you're hoping a stock really goes a lot higher or goes a lot lower. This, you want the stock to basically just continue to do what it has done in the past. And as you can see where these blue lines are, and you track them backwards, that in the last 3 months, this stock has not traded below 163.51 on any single day, and it has not traded above 196.49 on any single day. So as long as this company continues to do what it has done every single day for the last 3 months, between now and the middle of May, then I will make money off of this trade. On the other hand, if they report either a disastrous number on earnings and it plunges, or maybe it's the greatest number you've ever seen and it just erupts higher, then of course it will end up being a losing trade at that point. But our losses are defined by the way that we set up iron condors. Okay, so that's what I have for you here today and for the week. Thanks for sticking with me. For those of you, of course, and the premium classes as well, with my 5 classes that I taught today, capped off by a 5-hour extravaganza earlier today, in addition to the 2 market outlook videos I did here for you for free on YouTube. It's been a lot of fun working with you, even when David's away. And again, next week, David will be back on Monday. I will be off Monday, Tuesday, but I will be back for factor-based swing trading on Wednesday morning for those of you keeping track at home. So I hope all of you have a very enjoyable Easter holiday. Hope you get a chance to spend it with family and friends. It's a time of renewal. Hopefully you're getting some better weather than I am with all the snow we've had around here. But just get outside and unplug from the market for a bit, and then we'll be back in action and ready to tackle things once again next week. So until next time, I want to wish you all the best of success with your trades and your investments. Goodbye for now.